All right, let's take a look at another ETF that I'm using for some of my investment strategies. This one here is called GIAX, the Nicholas Global Equity in Income Fund. It's put out by Nicholas Wealth. You can find it easily on the web. First thing we want to look at is come down here to the yield. So the distribution rate. So it's paying about 24% dividends per year. So that comes out about 2% per month. I say about, obviously 24% is 2% a month, but it fluctuates a little bit depending on what the NAV is. And then it's not exactly 24%, but very close. So it's been around since July of 2024. I mentioned the NAV. It's currently trading about 19.28 per share. So here's the distribution details. The last distribution was on December 27th. Paid out about 38 cents per share. And you can see it's gone from 40, 39 down to 38. I don't like it when it goes down, but another reason for that is that the price of the share has dropped a little bit. Not enough for me to worry about, though. Here you can see where the future payouts are going to be. So basically, at the end of each month is when it will pay out. So what I want to do is jump down here to see what it's holding. The one thing that I like about this one is that it allows me a little bit of diversification in what I have. So you can see that it holds Vanguard S&P 500, but also has the Russell 2000. It has the Vanguard's small cap, Argentina, India, emerging markets. If you want, you could download all the holdings and look at it, but that's enough to get a good idea. So it looks like if you add up the top three holdings, that makes up about 50%, the NAV being 1924. And you can see it was launched in July 2024. You see these dips here. These dips happen after they pay dividend each month. So if it pays about 2% per month, you can expect the price to drop about 2% when they pay that out. And then over that month, it'll climb back up. Put the date again, September 6th, climbs back up. Over here, about October 3rd, takes a dip, climbs back up. Down here, end of October, takes another dip, and then climbs back up. November was a different type of month because of the election. The market as a whole was going pretty strong the entire month of November. So it didn't really take a dip when you would expected it to. Around here, it should have took a dip. But what it did do is when the market did take a dip in the middle of December, it took that dip pretty good, all the way down to 1854. And that's when I should have probably start buying in, but I didn't. So I bought in like right around here around 1928 per share. In the future, what I would do is look for these dips and buy. There might be an argument. People say you should buy right before they pay a dividend right here so you get that 2%, but it's going to drop 2%. If you wait for that dip, buy at the dip, and then your yield on cost will be better than if you bought it a little bit higher. So I'm not going to get into a lot of math about that, but just keep that in mind. That's my way of doing things. Other people might do it a different way. Long term, it probably doesn't make a big difference if you're buying it consistent over time. Let's go back, look at the fund here again. Something I like to look at when I'm buying these ETFs in funds that are after tax. This is not an IRA or 401k. This is a brokerage account that I'm paying tax on as I'm getting distributions typically. So let's go up here a little bit. So right here, there's a tab that says supplemental tax. And when you click on it, this tab opens. And what I'm looking for is these 19A 1 notices. If you click on that, another tab will open, which I've already opened. It tells you how this is working as far as tax is concerned. This is November 2024, and what I'm looking at is this return on capital. Of that distribution in November, 34 cents was return of capital, and about 5.5 cents was income. What I'm trying to do for the next 3 or 4 years is keep an eye on my income. I don't wanna be paying a bunch of money in taxes at this point in my life. I'm kinda in a little bit of a higher tax bracket. I wanna avoid paying tax as much as I can for the until a couple more years down the road. So, I'm not gonna get into details about that. Basically, what return of capital is, they're technically giving you back part of your initial investment. So, it's not taxed as dividends or interest or income. It's basically like paying your original money back to you. Over time, when they get done paying back 100% of your original investment, the dividends that they pay out will start being taxed as long-term capital gains. So at that point, you pay taxes on it. If this fund is earning about 25%, it shouldn't be until about year 3 or year 4 that I will start getting hit with capital gains tax. At that time, I'll be retired and we'll have lower reported income. So instead of paying like 22 or 24% in income tax on these returns, I'll be paying perhaps 10, 12%, depending on what the tax rate is at that point. So I'm taking my chances and betting that my tax rate will be lower in 3 or 4 years. Now, if I were to turn around and sell these shares in a couple of months, I'll have to pay tax on that distribution that I've gotten. The basis of what I paid will be adjusted based on how much I have had returned to me. Everything I just said is the way I understand return of capital, which I'm pretty confident is correct as far as my circumstances and the way I had to pay income taxes. Don't take my word for it. Do your own research. I'm just telling you why I'm picking certain funds that I'm picking. It boils down to 2 reasons. The rate of return, everybody wants that, but also how it's treated for tax consequences. So let's go back to this tab. Typically, when I'm looking at an ETF, I want something that's been around for a while, has a good track record. A lot of these ETFs do covered calls, and in this case, it's doing call spreads. They haven't been around for a long time, so it's hard to get a big, long track record on how they're performing. But the concepts of covered calls and call spreads, that's been around for a long time. There's been a lot of people who do that on their own. They go out and buy a stock or ETF, and then they trade those covered calls or call spreads themselves. Well, these funds are doing them for you, and I have confidence that they could probably do just as good a job as I can. Now, some people say, "Oh, I can do better than what this fund is doing," but in my opinion, you gotta kinda keep an eye on it, like, daily. You're constantly nervous about it, at least I am, get anxiety. Like, if I'm working during the day, I wanna keep jumping into the Fidelity account or Robinhood and see what's going on, and I can't always do that. I don't have time to do that during the day. So by using fund managers and like GIAX or AIPI and these other funds, they're doing that for me, and I have confidence that they're not gonna lose all my money like I might end up doing myself if I did it myself by not paying attention. So that's one of the reasons why I'm using these funds. The funds haven't been around a long time, but the concept has. I just mentioned call spreads, and I'm not going to explain what a call spread is, but if you want to know what a call spread is, there's a lot of YouTube videos. This YouTube channel called Wealth Adventures. He has a lot of good videos and he explains how these things works. It appears that he has traded those himself and he also reviews funds that use call spreads. If you want to know more about covered calls and call spreads, this guy here has some good videos. And there's several other YouTube channels that have some good videos. Not all YouTube channels explain things correct. Make sure that you verify what you hear, do a little extra reading on the side if you want to understand how it works. You don't need to be an expert at this stuff to buy a fund like GIAX. You just got to kind of understand what they're doing. So if you do lose all your money, you understand what went wrong. So the final thing I want to mention is I've been investing in these funds lately that earn anywhere from 10 to 35%. And people says, well, that won't keep up over time. And people that like to give advice sometimes don't understand how these funds work. Because the history of the stock market is like 8 to 12%, which is true. But this isn't counting on the stock market going up 8 to 12% each year. This is doing something a little bit different. This can go sideways. Actually, if I get back to this tab, if you look here, GIAX has gone mostly sideways and actually down a little bit. And I do expect this to bounce back up, and it is trending back up. It will be paying another dividend here in a few days, so it probably will dip down a little bit more. But I expect it to bounce back up. If you look here, it was all the way down to 1886 at one point and went all the way up to 2025. Even if the market goes down, they could still sell covered calls. They could still do these call spreads and generate income. They're generating income from the cover calls and the call spreads. They're not necessarily getting income from the price rising at a steady upward trend. It could bounce up and down and sideways forever and still potentially pay out 20 to 25% every year forever. So you want a little bit of volatility. You want it to bounce up and down. If it does go up over time, that's a bonus. It just needs to bounce up and down. A little bit up would be perfect. Long term, that's what I'm looking for. Okay, that wraps up why I'm using GIAX as one of my ETFs that I'm using for my investment strategy.